In a simulator, a losing trade is just a red number on a screen. On a live account, that same number represents actual purchasing power leaving your pocket. Before you execute that first live order, we are going to build a strict, airtight framework designed to protect your account from emotional decisions. You should already have two things in hand: a proven track record of consistency in your practice account and a clearly documented trading strategy. Finally, you must open a live brokerage account and fund it with only a micro amount of fully disposable capital. Success in these first weeks is measured by the quality of your psychological data, not the size of your returns. The first boundary you must set is position sizing. Start with the smallest possible fraction of your available capital, even if you can comfortably afford to risk more. By keeping your dollar risk infinitesimally small, a loss is less likely to trigger the fear response shown on this meter, allowing you to remain analytical. Think of it like getting behind the wheel of a car. You learn the pedals in an empty parking lot before ever attempting to merge onto a high-speed highway. The second boundary requires you to trade using the exact same parameters you used during your practice phase. 4 distinct variables must remain permanently locked: your specific entry triggers, where you place your stop loss, your take-profit targets, and the exact percentage of risk assigned to each trade. If you alter these roles while transitioning to live money, your performance data becomes entirely polluted. You won't be able to tell if your strategy failed or if an emotional error caused the loss. Because trading deals entirely in probabilities, you are inevitably going to experience losses during your first live sessions. The most common trap for beginners is reacting to that first string of losses by impulsively tweaking their indicators or switching timeframes. This is like completely rewriting a baking recipe every time a loaf of bread comes out slightly uneven, before you've mastered the oven itself. Taking a loss does not invalidate the mathematical edge of your trading system. Losses are simply a cost of doing business. Maintaining absolute consistency in your execution is the only way to generate reliable data on how your strategy performs over the long term. To enforce consistency, we rely on this 9-step trading checklist. Think of it as a mechanical firewall against impulsive decisions. Start by auditing your account balance and open positions, then clearly define the prevailing market trend. Next, locate any major support or resistance levels nearby and confirm your indicators align with the setup. Calculate your exact risk-to-reward ratio and strictly verify the micro amount of capital you are risking. Check the economic calendar for volatile news events that could impact the asset, and ensure the setup perfectly matches your master plan. Finally, ask if this trade requires bending the rules. Making an exception is a trap. Treating this exact sequence as a strict, non-negotiable protocol is the dividing line between professional risk management and amateur gambling. At this stage, your success is measured by execution quality. You score yourself purely on how perfectly you adhere to the plan, regardless of the financial outcome. A professional archer focuses entirely on their physical posture, breathing, and aim, completely ignoring the crowd and target. In the market, this means placing your entry order exactly where your plan dictates, setting a hard stop-loss immediately, and refusing to chase the price if it moves away from you. Above all, you must avoid the ultimate emotional failure, overriding your own system to manually exit a position early out of sudden panic. Demo accounts establish the mechanics. Real money builds the discipline. If you prioritize the training process now, profit follows as a natural result of consistent execution.